I interrupted Ed Yardeni, who is still standing by, Ed, and I just wanted to give it a quick chance to finish the conversation because this is one big question for the markets today. To what extent do U.S. investors have to care about the fiscal problems in Japan and the unwind? Can they ignore it? Is it a buying opportunity? Is it a preview of what's to come here?
Yeah, I think we've seen for the past year that this has been going on, and global investors basically ignored it. There was some concern about an unwinding of the yen carry trade. About a year ago, we had a day or two where that was an issue, and it didn't seem to be a situation that went global. So I don't think this is a Lehman moment. I don't think that what's going on in Japan is going to become a major global problem. However, Japan has been a leading indicator for developed economies and countries with regards to financing. And we saw that back in the 80s, they had a big stock market melt up. And then in the 90s, they went into a recession and they had to lower rates to zero. So the rest of the world followed that. They had QE. And now I think what we're seeing is the consequences are that the government is trying to stimulate their economy when inflation is still 3% and the bond yield is absolutely soaring because there's way too much debt over there. So I think this is a warning to the United States and to other countries that have high debt to GDP ratios that there needs to be something done about the wrong direction that these countries are on with regards to the finances.
So what do you do? And for a lot of investors have taken that concern all the way into a Bitcoin or all the way into gold or away from stocks, or and they've almost made the practical implications so immediate and so near term. But it sounds like you're sort of saying, yeah, it's a longer term issue. Hope they solve it.
Well, I think it has been a long term issue. I've been doing this for over 45 years, and I've got books on my shelf back there going back to the 80s about the debt problem and how it's going to create all sorts of debacles. One of these days it may do that. We came kind of close to a debt problem in the United States in 2023 when the bond yield soared from 4 to 5% in just 3 months. But the Treasury came up with a clever idea, and that is they decided to issue more bills and fewer bonds, and that calmed the bond market down. I don't think we're looking at a debt crisis in the U.S. up ahead here. With regards to gold, Kelly, I think what we're seeing here is just a much more unsettled and unsettling geopolitical environment. And in that situation, there's sort of a knee-jerk reaction to go into gold. But I think it's more than that, because it's clearly the precious metals, it's the base metals, it's rare earth minerals. And that all means that the geopolitical uncertainty definitely means more defense spending. And to produce defense equipment, we need more of these kind of metals.
Right. And so that's where, would you then, to put a point on it, Ed, look at those trades and say, yeah, you can stay in gold, you can stay in, so you can stay in any of this, versus I would expect someone like you at some point to say, look, when things start to go parabolic, we know what the other side of that looks like.
Yeah. I do feel uncomfortable when I see markets going straight up, because very often the next thing they do is they go straight down. To continue to own them and to get in at this point, you really have to believe that peace is not at hand, that we're not going to see things get much better on a geopolitical front. And we don't really know what the repercussions are of Trump's reinstituting the Monroe Doctrine in terms of the Putin Doctrine, that Ukraine belongs to Russia and maybe other parts of Europe, and it belongs to Russia. And then, of course, Xi's view that the China Sea belongs to China, and so does Taiwan.
Yeah. And we'll leave it there. I appreciate your time this hour, especially on a day and a moment like this. Ed Yardeni of Yardeni Research.